You're listening to the Financial Source podcast on YouTube.
I have to be honest, I refreshed my trading screen about 5 times this morning. I thought my internet was down. It's just weirdly quiet out there. It feels like the entire global financial system, just hit the pause button.
It's eerie, isn't it? But it makes perfect sense when you look at the calendar. We're in this massive liquidity vacuum right now.
Right.
You've got the Lunar New Year, which has most of Asia offline, and then bam, President's Day closes the U.S. markets.
So the two biggest engines are just off at the same time.
Exactly. You don't just get a slow day, you get a ghost town.
Right. Which brings us to our theme, thin liquidity, limited direction. But the thing about these quiet days, these ghost towns, is that they're not just boring. They can be fragile, can't they?
That is the perfect way to put it. Think of it like an empty room. When the market is full of volume, a big trade is like a shout that gets absorbed.
Yeah.
But right now, in this empty room, even a whisper echoes. A single big order can move the price dramatically because there's just no one on the other side to absorb the shock.
So we're all walking on eggshells. Okay, let's look at who actually did show up to work today. In the Asia-Pacific region, Australia seems to be the only one having a good time.
It's one bright spot, yeah. The ASX 200 was up about 0.4%.
And from what I'm seeing, that's almost entirely on the back of one giant, BHP.
It really is a story of one heavyweight just lifting the whole index. I mean, get this. BHP reported a 28% jump in first half profit.
28%. Wow, that's a massive beat.
A huge beat. And it basically dragged the entire mining sector and with it, the whole Australian index into the green.
But that also highlights the danger we were just talking about. That index number looks healthy, but if you peel back that one layer...
Exactly. If you strip out BHP, the broader sentiment in the region is actually pretty sour. You just have to look a little north to Japan to see the real mood.
Yeah, the Nikkei 225 was definitely not celebrating. It dropped nearly a full %. I know SoftBank was a big drag, and the GDP data wasn't great. But I feel like there's a bigger shadow hanging over Japan. The rumor mill is just churning about the Bank of Japan finally hiking rates in April.
That is the elephant in the room. For years, Japan has been the source of cheap money for the entire world, because of their zero or negative interest rates.
The ultimate carry trade.
If the BOJ actually hikes, they're effectively turning off that tap. And that is a huge deal. It sucks liquidity out of global markets.
Which explains why we're seeing some nervousness in the currency markets, even if things look flat on the surface.
Precisely. The euro and pound are drifting, but traders are getting nervous about the yen. They're starting to price in a world where that free money isn't free anymore.
And speaking of currencies, the RBA minutes for the Aussie dollar were out. The one word that just kept popping up was uncertainty.
It's the central bank's safe word right now. They're in a bind. They can't declare victory over inflation, but they don't want to signal they're about to crush the economy either. So, uncertainty it is.
Okay, speaking of things that are definitely not uncertain, I need you to explain something I saw in the commodities report because I honestly thought it was a typo.
Go on.
Gold. It said gold pulled back, but only after failing to hold the $5,000 level. $5,000 an ounce.
Not a typo. We were flirting with $5,000 gold.
That is absolutely wild. I remember when 2000 seemed like a ceiling. If gold is banging on the door of 5,000, that doesn't tell me the market is quiet. That tells me people are terrified.
It's the ultimate fear gauge, isn't it? Even though it pulled back about 1%, the fact that we even touched that psychological barrier shows how much stress is really in the system.
You don't buy gold at that price unless you think something is seriously wrong with fiat currencies.
It's the paradox. The stock market is asleep, but the safe haven assets are wide awake and screaming.
And meanwhile, oil is just sitting there staring at Geneva.
Totally paralyzed. You have these huge geopolitical negotiations happening, the U.S.-Iran talks, the Ukraine-Russia-U.S. situation. Oil traders are just waiting.
Waiting to see if diplomats walk out shaking hands or slamming doors.
That's the catalyst void we're in. There are no fresh macro drivers, so everyone is just waiting. Waiting for Geneva and waiting for the next round of U.S. economic data.
The ADP numbers, the NY Fed manufacturing. They're waiting for something to break the silence.
The market is coiled like a spring. We have this low liquidity, huge geopolitical stakes, and asset prices like gold at these historic, almost unbelievable levels.
So to wrap this up for you listening at home, do not mistake this silence for stability.
I'd agree. This feels much more like the calm before a very, very loud storm. When the volume comes back, All this pent-up energy has to go somewhere.
And we'll be here to break it down when it does. But for now, maybe keep an eye on that $5,000 gold price. It might just be the canary in the coal mine. Thanks for joining this deep dive. Stay sharp.